thanks everyone for joining in. I have Samir Arora, founder and fund manager at Helios Capital. Of course, he's a very well-known and celebrated market spokesperson. So I will not waste time in giving his introductions. So let's directly get going. Samir, are you good?
Yes, I'm good. Thank you very much. Yes.
Okay. So let's start, Samir, by asking you. Of course, you've always spoken about markets in general, but today I want to ask you a slightly contrarian question so that we can settle into the conversation.
Hmm.
Given the fact that interest rates in India and everywhere else around are reasonably good, people are getting very high returns on bonds, debt mutual funds, fixed deposits, etc. Uh, how do you react to a country like India with savers predominantly having looked at fixed income returns to look at equities in general?
Well, that in a big picture sense is easy to show that over any medium to long term, if you look at the last, say, 6, 7 years, you look at last 15 years, you look at last 20 odd years, or you look at 25, 28 years, which is in my career, basically the markets have gone up 13, 14, or maybe 15% per annum, depending on which index you use. Am I getting an echo or something? Because I can hear my own voice. Anyway,
No, I think we can hear you
it's
fine. We
okay.
can hear you
Okay.
fine.
So the big picture is that if you're getting 14, 15% per annum at the index level, there is no chance that any fixed income returns, except, in the US, when the rates were very high, like 17, 18% in 80s, then for many years, because those interest rates fell, even the bond guys could make similar kind of returns. But in general, a 13, 15% return is at least 5, 6% more than what you would get in the bonds of the same country, in this case, India, which is called equity risk premium. The problem with equity earning higher returns than debt is that even though it fairly compensates by giving this 5, 6% per annum higher return, it does not happen smoothly. If it was always the case that you will make 6% more in equities, nobody would put money in fixed income or in government or in bank deposits. But it doesn't happen evenly. And then, depending on various people's ability to handle periods when they might feel that, oh no, debt is doing better or bonds are doing better, is basically why you choose to have a mix. And sometimes you're trying to time this and sometimes trying to time that. But I would think that some 80, 90% of the money should be the way you think it should be in the long term, which is more towards equity. And maybe the last 5, 10%, you're trying to be cute about it in saying whether today this is better or that is better, just to keep everybody busy and active. Otherwise, there is no case anywhere in the world for debt versus equity, but still people do it for other reasons related to need, related to ability to handle, and maybe in some parts of equity might be more illiquid if they go into private, but otherwise there's no, this discussion is long been won by equity.
Okay, I think that makes perfect sense. In fact, one point that I've always debated with investors with us at Kotak
Hmm.
is that people invest into real estate, and in hindsight, in India, people have also made great returns in real estate in India.
Right.
I keep reminding them the fact that when you invest in real estate, you practically invest and you
For
forget.
10, 15
You
years.
look
Yeah.
back at it for 10, 15 years, and then you say that, real estate has always been a good, stable return category for me. If you were to give the same horizon to equities, you would possibly uh, get rewarded even better than what you would have in real estate. So, in some manner, I think both fixed income and real estate, to my mind, as you rightly said, given the kind of horizon in perspective, one can easily make the choice of which asset class suits best.
But the
So
thing
that's, I
is,
think,
there is no
yeah.
need to even tell the public that what we think and what they think. It is in black and white. I have data on indices for 20 years, 50 years, and even In the case of US, 200 years from a book. And you can see the data that equity beats everything. Real estate also, not only is it long term, for many of them, it is basically initially leveraged. So,
Correct.
you're buying
Absolutely.
on mortgage. So that also makes you feel that your returns were better. But in sometimes in India, because initially it was a repository of black money, it may have given higher returns. It's not going to be at that rate going forward, even if somebody did make it in the past.
You mean tax adjusted higher returns?
Because now you can't, yeah, you're not getting these extra this thing just because somebody wants to get rid of their black money. So they'll just put it into property, and therefore the next guy who's selling benefits, at least pre-tax. Yeah, you're right.
Correct, correct, correct. And let me also, while we are discussing asset classes, also touch upon gold, and more importantly, also because in some form or manner, gold has also been looked as a very, very important asset class as far as Indian investors are concerned. We know globally it doesn't form that significant an allocation in portfolios, but in India, I think gold has also been another asset class which has always found favor. So
I
any
think
thoughts on
gold is
that?
good. Yeah, I think gold is good because in India, it's a simple way of buying foreign exchange and basically effectively buying a dollar denominated asset without having to take anybody's permission or LRS and all that kind of stuff. Now, of course, there's a 10 odd percent duty, but previously there was no duty. So you were effectively converting some rupees into an alternative cash, this thing. But I would say that if somebody wanted to invest for 10, 20 years, you should have 10% in gold, 15% for end of the world type scenarios. These days, gold is particularly good because of many countries reasonably thinking that it is not safe for them to put all their money in US dollar denominated assets or in US dollar per se because of what the US did with Russian reserves. And, there are maybe 5, 10, or maybe I don't know how many 10 odd countries where there are sanctions. So any surpluses that these governments made in US dollar reserves, obviously they are trying to reduce. Even China would like to reduce in case there is a fight over Taiwan. Russia has lost some 180
Yeah,
billion, which in the end they might get back. But in the meantime, you would rather have these countries and many others. Even India might want to have a little bit more in gold just to be able to feel that these things are more in their own control rather than in case there's a fight with US on some ground.
yeah. In fact, you're right. Governments across have started to increase their own gold exposure. So, as individual investors, I think that would make sense to have some allocation going there. Uh, okay. With that aside, and with the conclusion that equity generally ends up being the favored class, let's get slightly more specific. And Samir, this is your area of expertise, so I'll want to dig deep into some of the thoughts. So, first and foremost, India has primarily been a market which has been driven by FIIs. Now, over the last 3 to 5 years, we have started to see huge participation coming from domestic investors, institutions, as well as individual investors. I think a large part of it also getting driven by huge amount of mutual fund flows that one is seeing. From data, I gather that almost 1.5 crore new individual investors have got added into mutual funds in the last 4 years, which is huge amount of money. So, do you think India has taken a turn for the good of not having to worry about how foreign investor thinks about Indian markets, and we are starting to become more self-sustained with respect to investors in Indian equities supporting the markets?
No, we don't have to say it like that, that now we don't need the foreign investor and now we are self-sufficient, because you will never be self-sufficient. India has a decent current account deficit. We will have, let's say we have a deficit. In the past, we used to have 3%. Now maybe it's 2%, let's say. That 2% means $60 billion a year. And
Yeah,
then, so you need it, whether you get it from FDI or FII. in that sense, FII money is better. FDI money requires many incentives, taxes, and then, in a sense, the company is controlled by the foreign parent, multinational, whatever. FII guy comes and supports mostly, let's say in theory, an Indian promoter or Indian companies. They may have 10, 20%. You can, tighten the rules, loosen the rules, and over time you are in more control. So you can't say that we don't want FII money or we only want this. But separately, the Indian public needed to put into equities, and they took too long, you can say. I was the first sort of mutual fund manager of India in the 90s. And at that time, uh, obviously, the same advertisements in a different form were being done as to why you should invest in mutual funds. Finally, it was, I think, demonetization, or God knows what the trigger was. But it is the right thing. And you can see that we are FIIs, and we are now trying hard to get a mutual fund license basically to become DII. So it's, you can see it even for me personally, that is the thing. But in general, what I'm saying is, let's not take it that, oh, now we have this, we don't need the foreigner. Sorry, we will always need the foreigner, and we should. It is part and parcel of growing up that you will need more capital than what you have. And there's no fight in that sense. Actually, both, in theory, we are waiting for the day when both want to buy, which should be sometime
Yeah.
soon. Because if, let us say that DIs are already now buying quite regularly, and the FIIs in the last 25 odd years have net sold only in 4 calendar years, which is 2008, 2011, I think 2018, and then last year. So, in
Hmm.
general, the propensity of the FI also is to buy, simply because even if the world grows at 2 3%, that means in theory the world has more money than previous time if they save X% of that. And that money then goes into whatever various asset classes, and India and others get some increase over previous year. It's just that when something happened which triggered a sale, then these are the 4 years only in 25 years. So ex ante, you have to believe that FIs will also buy, and buy in positive, and buy regularly in positive amounts. And those will be the good times when both categories want to buy rather than one selling to the other.
That's well said, actually. Uh, so both coexisting and both being bullish on India is the best situation, of course. Uh, Tell me something. You, of course, very closely watch how foreign investors would be looking at India and probably other markets as well. Uh, as of now, given the fact that there is that China plus one uh, theory that we have been hearing about, how do you think the global investor is looking at India in general?
Or they are, according to me, big picture desperate to be in India now. Because you can see that in the conversation and in the easy way that we can scare them into saying this. China plus one is very powerful, by the way. Actually, if you say one line story for India, it is China plus one, which is that both the FDI guy, or what you want to call the supply chain guy, or the multinational, is desperate to diversify away from China, if not a lot, a little bit, for various angles, starting with their wanting to have a second, third source of supply, having seen how zero COVID hurt them, even if China was doing okay, but the city in which these guys had their supply source getting locked down, or because of US China issues where China is no longer seen as a poor country to be helped, but more as a strategic competitor or a threat. Then the US having put technology, this thing, restrictions, which just shows today Microsoft has said that China has hacked into US tech infrastructure. So all these things, it's not only government. There are so many companies which are actually as big as many countries, and so they have to worry about all these things. And we, on the other side, India is giving all these incentives or PLI scheme or Make in India protection or lower taxes for newer companies or even reasonable taxes for older companies, and saying our demand is good and all that, and because of demographics, that India uh, labor is cheaper than US, sorry, than China. All these things are leading to them wanting to come to India. On the other side, on the FII side, it is that in the last 2 3 years, because of very easy to understand government of China issues related to sectors like edtech, then casinos, then this Alibaba gang, then the Didi, that where everybody would feel that it was government policy or government action that hurt those companies. Now, you tell me all these guys in the US, these Republican types, or even the purest stock market type, they want to buy companies and not believe that, oh, today is the government in favor or not in favor of that company or that sector. So
Yeah,
even they
correct.
have been pissed off. And obviously, the actual returns have been very poor. In the last 25 years, MSCI India, MSCI China returns would have been around 1.5% per annum, including dividend, everything. Whereas
Oh, okay.
India is around 11% per annum. So this is for 25 years.
This you are saying in dollar terms.
Yeah, dollar terms. Yeah.
Okay.
So people are pissed, but still, and in the index, India's weight, at least in MSCI emerging market, India is around 14% and China is still around 30. Maybe 2 3 years ago, China was 36 or so. And so they've come down because of just prices coming down or market cap coming down. So even if they're from that 30, I don't think people are putting 30% new money into China in that pool. Not in the, obviously, this is talking emerging market pool. So if they reduce it 2 3 4%, that is also mostly going to India. By the way, there is a expected meeting of the MSCI or an announcement in, I think, July, where they might
Hmm.
drop Korea from emerging markets, put it into developed market index. So
Okay.
what I mean is, in the end, it'll become that if you want to put in emerging markets, it's India plus China, and actually in the index there's Taiwan and all these, but I don't think anybody takes big picture views on those countries. Maybe they buy a TSMC or they don't buy, but the big picture
Hmm.
themes are always India, China. If you ignore all these tens of small countries, Saudi and South Africa and Mexico, who's putting money in those independently, other than just being part of some bucket called or a basket called emerging markets. So I think India will get from consolidation of emerging markets and also from relative to China a few percent. Not that we have to say that we will get all the money and they won't get, but we have to get a little bit more, and that is enough for us.
Yeah, in fact, when you say that, I remember 2015. Uh, I was we were having a conference, and Mark Mobius was talking about something similar. He said that India's weight that time was almost, I think, some 1/8 of the weight of China in emerging market basket, and he said easily this gap is going to keep contracting, and that passive flow itself, leave aside active managers
Yeah.
allocating money to India on a bottom-up basis, just the amount of passive money which is going to start to flow into India over the next decade is going to be
So just to
huge.
tell
So yeah,
you, in 1998, when I was an Asian fund manager, India's weight in the index was lower than Samsung Electronics weight. And now India's weight is higher than Korea's weight by 1%. Korea is some 13 and we are some 14 odd. And Taiwan is 16 or something. And China is just 30. So yeah, in the end it's going to be India, China and others if you want. I don't know what they want to buy, because in Korea, Taiwan, if you want to buy, you will buy 3 4 companies, whatever 3 4 are of interest, but the rest of it for a macro, I mean, global guy, why does he have to be in the sixth company in those countries? I don't know. Maybe they will.
true, true, true. Okay, let's turn back the attention more to India. Uh, in fact, rather, since we are talking global, let me just ask you one more question and then we'll turn back to India. So, there is this whole issue of the US debt crisis, right?
Hmm.
Uh, you think that's anything which is significant for Indian investors to bother, or you think it will possibly not be an issue at all?
So right now, everybody believes that it will not be an issue. In fact, today the what is the House Majority Leader, whatever, not Kevin McCarthy, has said that there is still time. So the issue is very simple. You know how it works. That these guys have a capacity which they agree to. Like today, the total debt is 31 trillion. Let's say. So they'll say, okay,
Correct.
okay. After a lot of negotiation, we agree that it should be 2 trillion more. So then in some 3 years, 2 years, 4 years, they run out of that capacity. And then in theory, they can't pay their bills because the government can only print, or whoever has can print, federal can only print that many dollars. So what happens is right now it has been estimated because nobody exactly knows which day it will run out, since your inflows coming and outflows going. And once it happened before that, it crossed the estimated deadline, and then the US government cut down on some simple things like staff of, museum staff, and they shut down some libraries and basically trying to save money for 1 or 2 more days. So it always goes to the wire. But right now the issue is only that the Republicans say that you must cut spending,
Yeah.
and Democrats are saying that we will freeze spending, that we will freeze it at last year's level or whatever. And these guys are saying you have to cut it a little, otherwise it will never come down. But in the end, they know that as soon as you don't pay an actual somebody's interest, even though that fellow also knows that 2 days later you will be paid, because it's not that forever. US will say, have a nice day. It is this negotiation. But as soon as you trigger that, in many of these rating companies, even though you know that, okay, my date is 31st and I will get it on 3rd because by that time these guys will have agreed, but you have had a delay in the interest. And
But
that,
at some point of time, the rating agencies have to
no,
take that
so
as a
just I'm saying, as a minor, whatever issue, not default, whatever is the word, event. And that is why the logic is given that, hey, today we are getting funding at this rate. If we have this minor event, the market will make our interest rate instead of 4%, 4.1%, that whatever, okay, that 0.1% into 30 trillion funding when we need will be so many billion losses. So you better agree in time. That's it. Today we have to believe it'll still happen. The market, if it is up today, everybody believes it'll happen. Who are we to say that it won't happen? Because this much everybody understands that if this is your debt and you still are in a deficit, sorry, this deficit will go up. You can just fight on how much to rein in your future spending. So as of now, yeah, no worries, it'll happen is the bet. But if it doesn't, it's quite bad.
yeah. It's like that black swan event that if it happens, it's really bad. Hopefully, it'll never happen.
Correct, correct, correct.
Okay, let's turn back into India then. So we've just finished the quarterly results, and per se, I think markets been where they have been for the last now almost 1.5 year or so. Generally, I think such kind of periods are followed by good market returns. But how do you read into how the story for India Inc. is looking basis last quarter or last 1 year?
No, so India story is looking good basically because I just believe in the big picture that it is logical, not just a history, that the Indian market has been giving returns in the mid teens, 13, 14, 15%. You can do it from various angles. You can do it from GDP in nominal terms, plus add 1 or 2% for corporate sector being better than the sectors which are not in the corporate world, or you can do it from equity risk premium, which is that you add 5-6% to the debt return, or you can do it from by anecdotally by just looking at a very large number of companies in IT, in consumer, in financials, broadly all growing 12 to 13, 14, 15%, and then some new guys growing at 30% and some guys growing at 5, 10, but mota mati, they all grow at 12, 15%. So if that kind of return has to be made, please understand that if you see our past many cycles, these cycles last, say, 6, 7, 8 years. So that you might have a peak in 91, then a peak in some 2000, then a peak in 2007 or 8. Then you may say, if you want, that 20, there was a big fall and then a new cycle. I don't know for the last one how to take it, but broadly, every 7, 8 years, there is a big fall. So if there's a big fall, say in a 7, 8, 10, whatever number of year cycle you want to call it, then the last that bad year takes away returns of that year plus previous 1 or 2 years. That means the market fall in eight will not just take away the returns of eight that, oh, I didn't make the 14% I was supposed to make, but it will take away the returns you made in the previous 1 or 2 years also. So, in a big picture sense, you are getting 14% per return in a maybe a 5 out of 7 year, or maybe 4 out of 7 years. And the other 3 years are going to be net zero, which means in the years that are good, you will make much more than 14%, maybe 18%. If that good year is not this year, at the beginning of the year, I thought it would be this year. I think it is definitely going to be next year because you will get enough. If it doesn't go up reasonably strongly this year, then you would have had 2 years where the returns are zero in nominal, I mean, in rupee terms. The interest rates in the US are not going to be cut this year, but they can reasonably be expected to be cut next year, even though the US market says they'll cut them in September and October, and the Federal Reserve says no. So let us say they get cut in Jan, Feb, or something like that next year. Then 4, 5 months before that, for us, Diwali time, New Year Eve time, new allocations time, then markets will get excited. So I still feel this year also will not be bad. I mean, it will be up like 10 odd percent, even in the balance 8 months, 7 months, whatever.
Okay.
But if it is
Okay.
not, you will get it with interest next year. I mean, if it
Okay.
remains plus
That's
minus
a good
another
way
4, 5%, yeah, you'll catch up because that is just the way it is. That the market is doing well, India is doing well, interest is there, and relatively our position is improved against nearly every pool. Every pool being means not just China. If you compare to Europe, you compare to even US little bit, although US is always a good market, or Japan. Broadly, India is now looking relatively good, and relatively good is the first thing to be in absolute good.
Okay. Okay. So versus rest of the world, yes. But standalone, how would you rate the results? Were they better than expected? Worse? And I have some numbers, so let me
You
first
only
give
tell
out
the
those
numbers.
numbers.
I will just say that my financials were good, but you tell the big picture numbers if you have them in a more precise way.
No, so I think I was looking at some data point that a research house had published. So about close to 350 companies had come out with their results out of the Nifty 500, and of which I think overall PAT growth or profit growth for the same was about 11%. But BFSI, as you rightly pointed out, was almost 29%, and non-BFSI, of course, was the one which dragged. Interestingly, the Nifty companies, almost about 43 out of 50 companies in Nifty had come out with the results when this was reported.
Hmm.
And there too, about the PAT growth was close to about 20%, 19.8% to be precise. And there are two questions in my mind when I look at that data. One question is, one, it looks like that generally the results seemed relatively better as per the research reports, and BFSI particularly was even better. But the other question which was coming to my mind is, Nifty companies are looking like they are uh, delivering better returns even at bigger sizes. So, is there a way for one to evaluate that this kind of a market environment is better suited for larger companies in India versus mid caps and small caps? So, two questions to that.
So first thing is I don't even look at these numbers. Good that you have a whole team wasting their time. So the big picture is that if you look at the large number of companies without anything, you can see that broadly a reasonably large part of the market keeps growing at, as I said, 10 to 15, 18% type returns. And then you have these 5, 10 big companies, whether it is Tata Motor or Tata Steel, or in the olden days, it used to be these PSU banks, which will either make you a few $1 billion or lose a few $1 billion. And they would change the entire index level profits and market level profits without making any difference to the rest of the companies. So maybe this year, if you see um, 20% growth for Nifty, Just look at Tata Motors suddenly going from normally making losses to in future making losses to currently making profits, or few of these. That's why I don't look at these aggregate numbers. Also, if you see that if these uh, commodity type companies or these very low stocks make a lot of profit suddenly, they change or inflate the profit pool of the group or of the corporate sector. But in theory, their value added is less, because if suddenly Tata Steel makes a lot of money, but sorry, Tata Steel gets only a 6 multiple, and therefore those earnings are not as valuable as somebody's getting a 30 multiple getting those profits. So therefore, in beyond a point, these things don't matter. You look at 85% of the market. You remove the top 10% of the great growers and remove the bottom 5-10% which have done badly. The rest will not be varying, I'm telling you, any day of last 15 years. They'll all have, not individually, but collectively, they'll have the same earnings growth for the last 15 years, is my big picture view. Therefore, this year EPS of Nifty being higher, or what you're saying, the wider 500 index being higher, I don't relate to it, or I don't have a feel for it, because it's been implanted in my head that these are because of these kind of companies.
Got it. Got it. But per se, would you prefer at this stage more large caps versus mid caps and small caps?
Actually,
Because mid caps, small
no,
caps.
we have not.
Yeah, sure.
And
Go
the
on.
reason we have not preferred right now, because we have taken a very negative view on IT. And so IT, which was generally about 15 to 20% of our long portfolio, is currently at zero. And that has gone into the rest of the market. And therefore, I don't know exactly, but I would think that if you look at our portfolio, compared it to 1.5 years ago, it would be average market cap would be lower, because not being in IT.
Okay. Okay. And since you mentioned IT, let me also ask you, and I, of course, have heard you earlier talking about you not preferring specific sectors or sectoral funds, but still, the trend that we see a lot, especially with the new millennial investors coming in and on our platform at Kotak Cherry, we find a lot of people now with the access of easily downloading an app and starting to invest. Uh, Finding favor in investing into thematic plays. People invest into banking funds, people invest into technology funds, people invest into specific sector funds. How do you think uh, different types of such investors, seasoned investors versus new investors, how should they really approach it? Should one
No, no. So
completely
the thing
stay
is,
away from them?
no, actually, there's nothing
Yeah.
wrong in that sense, because if you look at long term, many of these converge over time. It's just that we are a hedge fund, we are a bit more active, and we are willing to put our views strongly. But in the end, I'm not saying that IT forever is bad. In fact, we have a very big overweight in US IT in our US fund, or a global fund, but which is mostly US. But the thing is that if somebody puts in IT from now on, even if it was doing an SIP kind, even I don't think it is bad. It's just that last, say, less than 1 year, but approximately 1 year we've not had. And now I don't have, and maybe I'll wait for a quarter or so. So then who knows? I might be back to 15% or 10%. And people will remember that in this call I said I don't like IT. So, but I don't think it's a very big picture forever kind of a call. So people who are buying these can buy, I think, up to them. It's okay. Basically, they still do better than bank money or whatever else they're taking it out of. So it's okay.
Uh, okay. The only other possible piece of value I'll add there is, I think, from experience that we have seen at Kotak, as Samir was mentioning or referring earlier, it's just that I think it adds a little extra layer of elasticity. So, if a normal broader market index fund or diversified fund goes through volatilities that he spoke about, that you may get 13-14% return 1 year, it might drop to 5% return 1 year, and it over a period of time averages out. Sectoral funds can have far more
Yeah, correct.
volatility to it.
Range.
So
Correct,
people
correct.
who can, yeah, so people who can go through that volatility, I think, will also get
So
rewarded
in a
in the end.
big picture sense, we broadly like three themes, which is financials, IT, and consumer. It's just that for the last 1 year, first we reduced our weight in IT, and then we said once it is so obvious, why are we even trying to just say we are underweight or overweight? But in any institutional type, in the sense mutual fund type, you would say underweighted instead of saying zero. We are just a little bit more aggressive in life, and that has paid off. So we become like that. But generally, actually, the stocks, IT stocks, have done better than I would have thought, even though they are down.
Yeah. Yeah, in fact, that was one of the comments I think we received, and you sort of sufficiently answered that. Uh, Samir, let me also ask you additional or parameters outside of results and how companies perform that can impact equity markets in general. We, I think, as a country, have always been hugely dependent on things like monsoon.
Hmm.
Do you really think that those factors are important
Yes.
now, or have we come out and our dependencies on such factors have reduced?
No, no, it has not reduced. And actually, this year there is one risk. If you look at it, El Nino factors, it is showing that is already currently El Nino happening this year. This you can find on the net or Google. If you type, you'll see the El Nino factor is some 9 point something or something, which means that El Nino means this year no rain or very less rain. And you can say what you want that we will discount it, but it will affect a large number of people and it will affect some sectors. I don't think we've come out of it because we have not resolved the issue of giving decent alternative employment to 40-50% of India. So we cannot get away from it.
And for investors, is there any way to mitigate that risk, or again, you would say just depend on good fund managers to guide you through the.
No, first thing is that forget about the fund manager, who of course is very good. But the point is, if you look at, if I just tell you big picture, I was telling you, India in the last 25 years has beaten, in dollar terms, Mr. Buffett, the market. Okay, not fund managers who may have beaten it by 5-7% per annum also in India, which is impossible in the US. But our market has beaten Buffett and S&P and in Asia, Japan, and emerging market, and Europe and China and everything. But look at what all has happened in the last 25 years, from Kargil war to US sanctions in 98 to demon to lockdowns to Ketan Parekh scam to Russian crisis to global financial crisis, blah, 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 to whatever else you want to put, some droughts in some years, to one day when the market fell 17% when the Vajpayee government lost, to a government which lasted, I think, 13 days, which was also Mr. Vajpayee's government, to so many other things. After that, it's up 14-13% per annum in rupee terms and about 11% in dollar terms. So these things you can't overly precisely do, but it will affect. It might waste 2% returns and maybe waste 1% GDP, but to some part of the public, it will hurt badly. That is just the way it is, but that is what markets are. You cannot ever say that now there is no risk. There will always be a risk, but it is manageable just by changing the tenure, by saying, okay, I stay not necessarily with that stock, but with the market. So this is part and parcel of the game. Of course, a fund manager might say, okay, now I won't buy consumer or I won't buy rural consumer exposed and things like that, which also we don't know exactly whether El Nino is happening. And then B, maybe the government makes up and therefore the rural is okay, but the government deficit is higher. Therefore, actually financials do badly. These things can turn with you even knowing exactly the event, but not knowing how the response to that event will lead to. Do you think that is why you're supposed to own not 5 stocks, but 30-35 stocks? You're supposed to be able to see Netflix in the night and not worry that this has happened today evening, and today evening there is a forecast that drought has come or that the rainfall is short. You are supposed to just relax and play in that sense the long term. And maybe on the margin, fine tune 2 stocks here and 2 stocks there, but the core remains always more or less whatever you believe in. That's the only way to survive. I've done it for 27 years. I have never been burnt out. I'm always super excited. But you have to be able to handle periods. And the only way you can handle is by not overdoing anything.
So I guess it's easy to invest in the markets, but difficult to get your optimism about India.
The
Okay,
yeah.
Samir. Yeah, yeah.
Sorry.
Sorry, go on.
No, I'm saying optimism has paid off. In fact, Helios, this thing, what do you call it? Tagline is think bullish.
Good, interesting. Uh, in fact, I think I have run out of the time that I was allotted for this, but I will still, I think, given the thought process that we are in, I'm really enjoying this conversation. Maybe one last question I will try to squeeze in. So, you mentioned a little bit about number of stocks, and that just triggered the thought in my mind that we at Cherry typically find majority of investors, of course, doing a combination of mutual funds, but there are an increasing number of people who also come in and buy stocks on their own. So people who invest into mutual funds, as you rightly said, can actually leave it to the fund manager and go and watch something on Netflix. But for people who actually buy stocks on their own, uh, what would you say is a right number of stocks that people should look to buy in their portfolio? And it's a question that always intrigued
So an
me personally.
individual, I think an individual should have it around 20. We as a fund want to have around 35. Actually, I don't make a difference in my mind, but just for the heck of it, because somebody, oh, how an individual can have 35 stocks. I think he can have 50 stocks also, because you can see it in one of its tag. Pinned on our my Twitter account. But you can see that if you own for any year, just take last year, if you own the 150th best stock from the index, 150th best from the index, not some random unknown stock, you would have been ahead of each and every fund manager of India, including me. Every. And you can see it year after
Wow.
year that even owning the 150th stock, on average, if you own only the 150th stock each year for the last 18 years, and why we take 18 years is because Helios started 18 years ago, you may have made 100 times your money while the market is up 11 times. You can see the exact numbers, it's in many of my webinars. So, what we want to show is that every year, some 150 stocks from the index, which is the 500 index we're talking about, are
Yeah,
beating the index with the 150th stock beating the index by around 10%. Point
that's a
being,
very
point
interesting point.
being,
Yeah.
point being not that 10 stocks create wealth and all. That is the biggest lie that anybody has told you. It is not only a lie, it's a deliberate misinterpretation. So how that
Yeah.
misinterpretation works is that if you look at Reliance Industries, now Reliance Industries has a 100 and pata nahi kitna, 80 billion, let's say, market cap.
Mhm.
So next year, if you say add everybody's increase of market cap, and then you'll find that Reliance went up, say, 15%. So it
Mhm.
added 27 billion of market net worth or market, so not net worth, I mean wealth, right? Now,
Yeah.
so every time you will see that top 10 stocks create so much wealth just because they are so big to start with. For normal folks like us, the the wealth increase is not in absolute dollars, but in percentage.
Correct. Correct. Yeah. It matters to me what I
Not
have
not in
invested in.
absolute. How does it matter to me that TCS alone created 20 billion of wealth, and therefore when you add the wealth, there is one fund manager who will say, "See, top 10 companies created 90% of the wealth." What does it tell me the percentage return? I am interested that whether my 10 billion company became 13 billion, which is actually added only 3 billion of wealth. Whereas
Yeah.
some big
Yeah.
company went up only 10%, created 20 billion of wealth. So according to me, which one should I say has created more wealth? I mean, deliberate distortion of the facts, no, that 90% of profits are made by 10 companies. I mean, absolute deliberate. So, anyway, so the bottom line is these are real numbers that 150 companies. And how did it come to 150? It's not some random number. There are 500 companies in the market. The index is an average of these 500 companies, although weighted by market cap, may I add, so that somebody doesn't say, oh, it's not plain average. But it doesn't change the fact that an average normally ends up being somewhere in the middle of those 500 companies. So some 200 odd companies are beating the index, some 300 companies are being beaten by the index. It is just the way it is. Just arithmetic of 500 numbers. So if 200 odd companies are beating the index, by definition, 175 are beating it by a bigger number because that 200 and except number, which let's say is 230. So if the 230th company is beating the index and therefore 270 are being beaten by the index, then the 200th company is better than the 230th, and by
No,
just
I think
us
that's
the 150th is
very,
much bigger.
yeah.
So you can buy 50 companies also, you will do as well according to me if you get a large part of your 50 in that 150.
Yeah, no, I think I'm definitely going to take up on that analysis and maybe tag that analysis
So you
accordingly
buy
to this
as many
reference as well.
companies, it is more fun to own more companies. It is more fun because even if you have a few shares, you'll read about it, you'll read it. You when that stock does well, you'll be happier to add to it because you'll say it is my stock. Imagine a stock like, let's say, Nvidia, and you say I refuse to buy before. Now today it goes up 28%. If you had it, because it doesn't matter, I'll add half percent more. Anyway, my stock has gone up so much. Obviously, you may not buy above 28% rally, but generally what I mean is, if a stock you have bought a little bit and you're waiting for confirmation, it is easier to add later instead of saying, I thought of this stock at 100, but I didn't have the courage and now it's become 150. So how can I buy? Instead, if you bought half percent at 100 while fairly thinking that it's okay and it goes to 150, you don't feel that, oh, how can I add now? You can say it's my stock. If I bet another half percent now, my average will be only 120, 125, blah, blah, blah. That is how life is. That is how you can do it again and again. Otherwise, you keep waiting
No,
for that
actually,
one
that's a
day you'll
very
get
important
conviction.
point. That's a very important point, confirmation bias, and I'm sure our investors would appreciate that point a lot because a lot of times you end up waiting for that right price and you never get to that
Keep
price, so you
waiting.
never end up buying
Yeah.
a good stock. So that's a good price. And with that, I think Samir, thank you so much for your
Okay, very
time.
good.
Thank you for making it to this chat with us at Kotak Cherry. And thanks to all our listeners. It was great to have you guys. Look forward to many more such conversations with great people like Samir. So thank you, one
Thank
and
you,
all.
man. Thank you, guys.